In this video, I'm going to talk about why I think ETFs are the best way to invest for most people. And please stay to the end because I also want to talk about why you might want to add some ETFs even if you currently invest solely in actively picked stocks. Now, I just want to point out that we're not talking retirement funds. We're talking investing with your taxable income. So if you've been following my channel for any period of time, that you know then that I invest primarily in actively picked stocks. Most of the viewers of my channel also invest in actively picked stocks. That's not most people though. Most people who want to invest, I mean, they want to invest, but like, they don't want to spend all of their fucking time reading 10Ks and researching companies and listening to earnings calls over and over and over. Like, they have different goals in that. Now, is it true that you can make more money with actively picked stocks? You have the potential to make more money with actively picked stocks than ETFs? Absolutely. But with actively picked stocks, you got to put in the work. There's a lot of work. The reason I invest in actively picked stocks is because I enjoy it. Like over the years, I've come to enjoy researching companies. I like it. But a lot of people just don't want to fucking do that, and that's fine. They don't need to make all the money in the world. And for those people, I think buying ETFs makes the most sense. It's very easy to get started because you can buy and sell them just like buying and selling stocks. And there's far less research you need to do before, buying one. So we're going to use Vanguard and later Fidelity to help me in my examples here, because these are some of the more common places where you're going to get ETFs. An ETF is pretty much a basket containing fractions of stocks. And they sort of follow Rule 35, which is if something exists, there's an ETF of it. There's baskets for bonds, there's baskets for corporate bonds, there's baskets just for high-end yield ETFs, there's one that tracks the S&P 500, and there's one we're going to look at right now, which is the total stock market. And if you're just starting and you want to start investing, these are one of the ones that I recommend. Because the goal of this is to track the overall performance of the stock market. And the reason why this is probably one of the better places to start is because as long as we have a functioning economy and things are going well, the economy is expected to rise over time instead of shrink. So as long as we don't have a societal collapse, this is supposed to make money over time. And if you look at the performance here, we're talking 60% year to date, and then roughly 10% over a 1 year period, 11.4% over each year for 5 years, and so on and so on and so on. So let's take a look at the VTI. So this is the VTI, and one share of a VTI is currently $187.48. And like I said earlier, I mean, they buy and sell like stocks. So if you want to buy one, you just click on buy, and then you look up the shares, and then you do your thing. Now, if you go to portfolio and management, and you scroll down here to this other stuff here, you can see its top 10 holdings. So, like I said, remember when I said that each share of ETF is a basket of stocks? Well, each share will contain a fraction of Apple, a fraction of Microsoft, a fraction of Amazon, and so on and so on and so on. If you click down here on portfolio holdings, if you really want to, you can see every single stock that makes up this ETF. When I say it tracks the total stock market, it's tracking all these 3,555 stocks. One thing I want to point out is that you don't actually have any control over what's in the ETF. You can only control how many shares of that ETF you decide to buy. Now, other than the performance and the number of holdings, the only other thing that we need to look at right now is the expense ratio. So it costs money for this ETF to run, and that money is taken out of your holdings. Now, don't get scared. These expense ratios, which is what they're called, is really low. Like, for example, this is 0.03. 0.03. Now, if you take a look at the performance, we're talking 11% gain a year for 5 years, assuming that past performance holds a candle to future performance. If you get returns anywhere close to that over each year, that 0.03% expense ratio is nothing. Now, in Fidelity, you just go to News, ETFs. We're going to take a look at Fidelity ETFs. All Fidelity ETFs. And here you go. These are the Fidelity ETFs. And it's basically whatever you want to buy. Whatever ETF looks promising to you. Let's do information technology. Right now they have an expense ratio of 0.084%, which is really good. And if you scroll down to here, you can see their top 10 holdings, and if you click more, you can view all of their holdings. So, and buying an ETF here is just as simple as buying here and buying as many shares as you want. Now, with ETFs and, you know, passive investing in general, fair value doesn't really mean a whole lot, you know, because there's passive investing. Basically, you're going to do what's called DCA, which is like, for example, you're going to, let's say you spend $400 every single month buying the ETF that you chose. Now, for each month, that $400 is going to buy more or less shares depending on the price of the share. And that's how you do over time. As long as we have a functioning economy with the stock market, with an economy that grows over time, you are very likely to make money. And I would even pick ETFs over mutual funds. Now, the thing with mutual funds is a mutual fund is actively managed by a human or a group of humans. ETFs are not. They're managed by just an index. And because mutual funds involve humans, you typically pay a higher expense ratio. Now, depending on the mutual, so the goal of a mutual fund is not just to, you know, match the market. They're trying to beat the market. And if you do some research, you'll find that a lot of those mutual funds, they don't do that. The market beats them. You have to pay that higher expense ratio for a mutual fund, whether you make money or whether you lose money. And I just feel that, you know, buying ETFs using DCA will get you a better return over the lifetime of your investment. But that depends on the mutual fund that you choose. So what if you already own and invest and actively pick stocks? Is there any reason for you to consider adding ETFs to your portfolio? Well, let me show you. This is my current portfolio. I own a lot of positions. I've been trying to, you know, whittle them down a little bit, but I'm not doing a very good job. I own a lot of positions, and a lot of them are tech related because tech is what I do. Now, maybe I want to diversify and I want to add some more positions to different sectors, but as I mentioned at the very beginning, you know, managing and, you know, reading up on all these companies and keeping up with the news, all this takes a lot of work, especially with the earnings calls and stuff. That's a lot, and I don't know if I want to add more and more positions because that's more and more companies that I need to keep track of. So I think adding an ETF would allow me to diversify a little bit without having to worry about adding more and more positions. I could just passively invest in that ETF and let that ETF do the work for me. And the second reason you might want to add ETFs to your portfolio, and this goes along with the first one a little bit, is to diversify into sectors that, or industries that you don't understand. Looking back to my portfolio, reading up on Pfizer was a chore. Like, it was a lot. Like, healthcare is not my skill set. Tech, I can do that all day. Pfizer was a lot. Like, healthcare and even Johnson & Johnson, that was a lot. And looking back, even though Pfizer's doing well, and I understand them enough to know that they, you know, they make vaccines and pharmaceuticals, that 10K used terms that I don't understand and still don't understand today. In other words, I probably don't have any business being in Pfizer. And maybe not Johnson & Johnson, even though I'm going to still hold them, but I'm just saying, I don't have any business being in either of these. I don't understand pharmaceuticals or vaccines that much to be able to know whether, you know, something that Pfizer says is a good thing or not. What I might want to do in the future is, instead of just doing Pfizer or Johnson & Johnson, is maybe find a healthcare ETF and buy into that. That way I can still diversify. I can still support, you know, another sector, another industry, but I don't have to worry about business models or anything like that. I can just let the index do the work for me. And on the flip side, I know there are a lot of people who don't understand tech that well. For example, I'm a network engineer. Not a lot of people, you know, understand networking or what a switch does or what a router does and all that stuff. So maybe reading up on Cisco isn't the best thing for them. Or reading up on Cloudera, big data, that may not be for them. They could find an information technology ETF, which we just looked at, and invest in that. That way they're diversifying, they're supporting the sector, but they don't have to read up all this shit that they don't understand, and they don't have to try to understand. And just to show you that I eat my own dog food, I've already started an ETF position here with ARK, and I have an ETF position here and Vanguard. Anyways, hope you enjoyed this video. Thanks for watching, and eat your vegetables.